It's contract payment review. Are we getting what we pay for? That's what we're going to be talking about today. Again, myself and Stefan Ramcharan will be switching in and out throughout the presentation. So we wanted to throw this in there to know that this is the exact same presentation as it was in the past, contract monitoring. So if you've been to this presentation in the past, you're going to hear the similar information as before. We changed the title because in the past, we've got some feedback that people thought that it was related more to the actual contracts, and we will be focusing on the payment side on how to monitor the payments related to contracts. So why are we here? We're here because we have a duty and a mission to carry out. Today's duty and mission is to learn about monitoring. We each have our own missions. Depending on your agency, you have your own mission on what it is you want to accomplish. And all of that is to provide services to those individuals of the state to ensure that we're getting what we're paying for. And that's why we're here. Throughout this presentation, we're going to talk about the monitoring necessity, challenges and concerns, impacts you may that not monitoring can have. We're going to go over the 7-step process that we use. We're going to talk about fraud within those 7-step process, and we're going to talk about field visits as well. So monitoring necessity, why is it important? Again, we just talked about every agency has their own missions. We spend billions in state spending to ensure that each agency gets their mission accomplished. Within that, if we're not getting the services or goods that we requested, there are certain risks. We can have health and safety impacts. If you're looking for services related to nursing and you're getting unlicensed nurses, you might not have the quality of care that you're paying for. In addition, let's talk about like elevator maintenance. If you're paying for elevators to get maintenance and they're not getting their maintenance, there's a possibility that an elevator can crash, people can get injured. So that's health and safety. Goal achievement, that's ensuring that the goal is being met for those contracts. So if you're not getting what you're paying for, you might not achieve the goals. Dollars, we just talked about the billions in state spending. That's just money going out the door and you're not getting anything in return. And then there's reputation. So there's times in the past where it's been known that we uncover fraud or billions in spending and we don't achieve our goals, and that goes out in the media. And now that's like a light shine on your agency that you're not doing what you're supposed to. So we also do it to ensure that our reputation stays good and that we are doing what we're supposed to be doing. Also, we also check for fraud and we look for errors as well. And we're going to talk about fraud and errors and what it amounts to, the impact of that a little later on. Challenges and concerns. So think about what challenges do you have at your agency in monitoring payments and monitoring contracts. So over the years, we've given this presentation a lot, and we have kind of like the common denominators on what those are. So we're talking about like lack of resources. I don't know about you guys, but at our agency, we don't have people just sitting around waiting to see what can I do today. You know, our resources are limited, whether it's time to do things or funding or staff. Talking about staff, we have staff turnover. So as people leave your agency, they will be taking experience, they will be taking knowledge with them. And we may not have new people to step right up that have that knowledge and experience. They may lack the training. There may be lack of communication between the program and the fiscal departments, which we're going to touch on a little bit later. Then there's also vendor compliance. Well, the vendor's not supplying everything they're supposed to ensure adequate payment is processed on time, or they're providing things at the last minute, and now I got to rush to review these things to make sure that they get paid on time. So those are kind of some of the common concerns that we've heard from agencies, and we're going to touch on some of these and what we can do to help that throughout this presentation. The impact. So about 10 years ago now, there was a big scandal at the New York City with the New York City payroll project that was going down in New York City. What happened was there was this contract that was about $63 million. And over the span of 9 years, it ballooned up from $60 million to almost $600 million. And come to find out, about $500 million of that, there was some sort of issues with it, whether it was fraud related. There were shell companies, there were vendors being selected to be contractors to subcontract. So we were paying like a markup each time along the way. Ultimately, it boiled down to the monitoring was kind of outsourced to a contractor, a vendor, and they weren't really doing the monitoring. They were actually doing some of the scheming as well. So there was nobody at the agency that was actually monitoring this contract. And instead of ensuring that things were done timely, and that vendors were selected appropriately through the bidding process and everything like that, or subcontractors and things like that, it ended up that there was no monitoring, and all this ballooned up, and about $500 million worth later of cases that we didn't really actually receive. So we talked about the reputation. So imagine having that tied to your agency name, and then the millions of dollars that went out the door. So that was what we were talking about as far as impact. Next, we're going to go straight into the 7-step process. There's a section in the GFO, the Guide to Financial Operations, in section 11, chapter 11F. So 1111F. And it goes over this process, and it breaks down each one in like summaries. Additionally, in there's also examples like spreadsheets that help you walk through it, depending on the type of contract you're looking at, whether it's goods, services, grants. It's in there as well. And there's a link to it at the end of this presentation, so don't worry. We're going to go through it. The first one is going to be identify contracts for review. So basically, we got to identify what contracts to look at. Then we got to understand the contract terms within that contract in order to then identify the risks, like what can go wrong with that. So we identify the risks, then we can prioritize the risks. We can determine what our response is going to be to those risks. We can design and execute monitoring activities. And then at the end, how we follow up. And we're going to go through each one of these steps one by one. That, turn it over to Vaughn.
That is perfect. Thank you so much, Jen. So the first step we're going to talk about is how to identify contracts for review. So there's a famous quote that states, needle in a haystack. It means trying to find something small in something large. Well, according to Open Book, something we will speak about in a few slides, there are about 193,000 contracts across state agencies. Well, trying to find one risky contract out of 193,000 can be as difficult as trying to find a needle in a haystack. Well, you may have additional resources such as like software programs that could assist with that. And 2 questions you can ask yourselves are, what data do you have available? And how can I help you to identify these type of contracts? And as Jen mentioned in a few slides, these are just some of the risks associated. So it's like the dollars or the reputation. So over the past few years, we have been given this presentation, and a large number of people did not know or have used this free and available resource. It's called Open Books. So for people who have seen Open Books in the past, as you can see, the layout has changed. And Open Book, you can Google search Open Book, and you do not have to sign up for it. It's free and available. For the purpose of this presentation, we're going to use state contracts, but in future slides, we're going to briefly touch upon state payments. After we select state payments, this is the screen that populates, and we can, we can search for contracts based on several criteria. You can search based on the agency, the vendor name, or the contract period. For purposes of this presentation, we will use Department of Health as the agency. So when we first created the slides for this presentation, there were about 13,292 contracts DOH has with vendors. As of this morning, there are approximately 13,500 contracts according to Open Books. And after we enter criteria in, we have the option to download the results to an Excel spreadsheet, which the red arrow is pointing to as of right now. So this is how the data looks when we download it to an Excel spreadsheet, and and it's more manageable when we're able to do much more within Excel. As you guys saw in the previous slide, there are a lot of information within Excel, and it allows us to do multiple things. We can sort and filter on it, and we will list some of those preferences on the next 2 slides. So you can sort contracts by the type, the contract date, the contract amount, and these are some examples we're gonna give as well. There are other risks to keep in mind which the data cannot provide. So for example, the quality of products and services. So maybe you may have issue with a vendor where they're providing the products, but there are deficiencies within it. You're not getting the right services. You're not getting the right goods. Problems with vendors, maybe they're billing the incorrect rate. Current events, most popular thing right now, it's COVID. So let's just say, for example, there's a vendor, they're selling N95 masks. And let's just say, for example, the agency decided to buy N95 masks, but when they received the products, they didn't get the N95 mask, they got a different type. So this is just some of the examples on locations. Like there could be like issues with a certain type of goods or services, like supply from a certain area. So that may increase like concerns for like similar contracts within that region, city, or area. As we said, when you download the information to Excel, you can do multiple things. So in this example, you can filter on it as well. So the first thing we're going to do, you can do within this. So you can filter by contract end date to eliminate expired contracts. So if we eliminate expired contracts, we can focus on live payments or the pre-audit, and vice versa, where we can focus on expired contract or a post-audit. Perfect, thank you. So it's the same explanation as the prior slide. Instead, we're using dollars instead of dates. So a contract can have like extra years or dates, but the amount could be fully expended. Every contract has its own risks, and we will go over 3 contract types that are inherently more risky. So for the first one, it's consultant. The first one we're gonna touch upon. So with consultants, so agency may not have like the resources or staff to complete like certain projects or work. Well, one of the risks is like, how do I know that the work is good? So for example, let's just say a consultant comes in to build like a system software. Well, at the agency level, you might not know what they're doing because they're their expertise. They're the one that's building the system and they know what's going on. So that's just one of the risks. It's like, how do I know that the work is good? And the second contract we're going to talk about is grants. So there's a mindset that it's free money. And the third one is services. So for services, these are things that have been performed in the past. So well, how do we know that these services were provided? So we might have to like rely on documentation. So similar in the past few slides, as we stated, when you download information to Excel spreadsheet, you're able to do more. So within this slide, you can filter on more than one column. So you can filter on current contract amount or contract type. So in this example, we can filter on contract start date. So the first one we're going to talk about is older contracts, right? So what are the risks with older contract? So for example, with older contracts, we're familiar with those contracts, and we might not encounter much issues, right? So now the vendor knows going a few years down the road, you might not look at those, but now the vendor knows. It's like they know what's needed for review. They know like the control. They know the control of what's been in the past. So now you're looking at it and you're like, okay, down the road, maybe the goods or services are not the best quality versus newer contracts. there are unknown controls and maybe the vendor is not aware of like the contract terms or they bill in inappropriately. As stated in the prior slide, so we can create additional columns to help in our analysis with selecting like a contract. So as we can see, the 3 columns, they are highlighted in gray. Percentage expended, so how much was spent on the contract as a percentage, and percentage life expended, how much of the contract terms have been expended. And the 3rd column, percentage expended minus percentage life, we're just trying to figure out the difference between the 2 columns. So for example, let's just say we're looking at a 5-year contract and we notice that 50% was already spent in year 1. Well, one might ask themselves why. Well, maybe it was a construction contract and they had to like buy equipment or supplies to start a project. But what if the contract is almost over and nothing was spent? So one of the things you might ask yourself is, well, maybe the goals of the contract are not met. So maybe we should look further into that. Summaries. As I stated in our previous slides, we will focus on state contracts, the option, but this is the slide we would talk about the state payments option. Well, the first 3 columns are from Open Book, and we added the 4th column. So we just want to determine the average payment amount. This can help you to determine like high dollar payments or which vendors receiving high number of payments. This can help you with that. So you have selected a contract. Now what? Now we have to like monitor that. But what is that really? So in monitoring, you're just ensuring that controls are operating as intended. So controls purpose, I have an acronym for that. It's C. It's called CARES, compliance with laws, accomplish goals and objectives, relevant data, efficient operations, and safeguarding assets. So this is the internal controls pyramid. We can spend 2 to 3 days talking about internal controls, but for purposes of this presentation, as we can see at the top of the pyramid, it's monitoring. We're just ensuring that things are operating as intended. And for this slide, the difference between the definition with this slide and the previous slide, we're just ensuring that contractors are operating as intended. And how do agency employees and contractors know what's intended? Well, Jen is going to speak about that now.
All right. So I heard there might have been some connectivity issues. I didn't hear anything. Hopefully I resolved that and you can hear me better and clearer. So Stefan talked about finding contracts, right? Now that you've identified some contracts you want to look at, now step 2 is, now we got to understand what are the contract terms within those contracts. So how do you do that? Some people think it's common sense, reasoning, right? Conversation. There could be purchase order details, contract specifications, laws, rules, and regulations, guidelines. What we mean by reasoning is by knowing that you have to pay for items, goods, or services that are just due and knowing, it doesn't have to be explicit to say that we have to pay for items just once, or that we're paying for what it is we're receiving. That's kind of just indicative of paying for goods or services that you are receiving and in compliance with the contracts. So it doesn't have to explicitly say everything in the contract saying don't bill twice for something. Conversation, sometimes you'll see in contracts that there will be like a Q&A type document inside where it gives a little bit more information on what they meant by certain contract terms that are kind of after you've had conversations between the contractor and the agency. There could be some purchase order details, the specific actual contract specification, laws, rules, and regulations. By that is that there could be references to laws, rules, and regulations. It doesn't have to explicitly say that if you're paying for an hourly service, that those individuals have to take a lunch break if they work more than 6 hours. It's by inferring to making sure you abide by DOL laws. That's what that means. And then any other specific guidelines for a specific program or type of payment or grant. So requirements is understanding, right? Assessing the quality of the contract term. So we can ask ourselves, how can I verify whether something's occurred based on how the contract specification is written? And we use something called SMART. I'm sure most of you have possibly heard this in SMART goals, right? So a specific, measurable, achievable, relevant, and time bound. The way I heard it a long time ago was more about like losing weight, right? Making sure you know how much weight you want to lose. How are you going to measure it? Is it going to be inches? Is it going to be a scale? You know, pounds. Is it achievable? Can I say I'm going to lose 50 pounds in 1 week? That's probably not achievable, right? So those are the kind of specifics, and we're going to go into that. For specific, so if you're going over a contract, let's say we're doing an outreach contract, right? So let's say, since we're on DOH, that there's a certain area that is having some sort of communicable disease, that there's an uptick in it, and we want to do some outreach to try to diminish that, to decrease that. So what specifics could we have in the contract? Well, what area, what region are we talking about? What are the deliverables? What kind of outreach? Are we talking about phone calls? Are we talking about emails? Are we talking about people out handing out pamphlets? What is it specifically that is clearly visible and understood? What it is that we're actually requesting that they're going to be providing, and not just saying we want outreach in this area, and that's the end of it. We need specifics in there on what it is and what location. Are there certain zip codes specifically that outreach has to be given to? If it's calls, or there certain area codes that we're talking about? Measurable. So now we have, okay, we're going to do calls. Well, then how much? How many calls? Is there a certain amount of calls in a certain time period? Is there a certain amount of calls altogether? What's the timing of it? Does the outreach supposed, like, if the uptick is between the summer months, between May, let's say, or June, because it even snows here in May sometimes. I'm from Florida, so snow's not my thing. So let's say from June till like September, right? If that's where we want the outreach to take place, so we need to make sure that that's included in there. For expertise, that wouldn't really pertain to like outreach, but that's more along the lines when we were talking about like nursing. If you need certain level of certifications or degrees for a certain type of service, like if we want registered nurses, well, then that should be in there to ensure that they are going to be registered nurses and they need to provide documentation as such. Achievable. So this is when we talked about the thing about losing 50 pounds in a week. That's not achievable. So is it achievable, the numbers we were just talking about, the measurable? Additionally, it's achievable the triggers, like the payment triggers, the invoice formats. What is it you need in there? Making sure it's achievable. Let's say you have a contract with a vendor that's like a mom and pop type, a small business, right? And maybe they don't have electronic timesheets. Well, was that a requirement that now you're telling them they have to provide? Or maybe that's something that should have been outlined in like the RFP or the RFQ when you're sending out for bid, to ensure that that is one of the things that you're requiring and that they need to meet that in order to be able to submit a bid and get awarded the bid. Relevant. So let's say we're doing calls. Well, then our timesheets, what we would request to be submitted with documentation, or would it be more on call logs? Well, that depends on what we're paying for. If we're paying by the number of calls, well, call logs would seem more relevant and more reasonable than timesheets, because who knows how many calls they made during that timesheet. If that's not what we're measuring, then that might not be something that we need to receive. And finally, time bound. So this is kind of goes back, these all kind of mesh together, but in the reasonableness of it. So if they're doing calls all the way up to like the 31st or the 30th of the last month, is it reasonable to say that, hey, if you want to get paid by the 15th, you need to have all the documentation over to us by the 1st? Well, they were just making calls yesterday. So is it reasonable to set time frames, like if you send all your documentation by the 5th, it's reasonable that you're going to get paid by the 15th, or whatever it is the terms are within your contract. And then within every contract, we also need to include, like the right to audit, specify that the monitoring contract language, and if there's any consequences for non-compliance. Going back to the example we gave earlier about the payroll scandal, a lot of the things were that they didn't have time bound. So they weren't saying you have to meet certain deadlines by certain dates, and they weren't enforcing them, which then led to more amendments and more hours and more hours, and it kept adding and ballooning up, and we were paying for a lot more than we were actually getting. So here's a specification example. I'm going to read it because I see there are some callers on the line. So the specification, this came from an actual contract. We pulled this this specification out of there. It said the vendor shall submit a properly executed application for payment together with appropriate backup supporting the amount billed. So, okay, how can we smart this up? Or is there anything that is might be a little bit vague? Well, to me, what is a properly executed application, right? Can that be detailed out somewhere? Is there, for a properly executed application, you need to have this, this, and this for payment, right? Or is there, please see example E. Is there an example of it somewhere? Then it says together with appropriate backup. Well, what is appropriate backup? Depending on what the contract is, right? If it's for nursing and you need proof that they're registered nurses that are providing the services and timesheets or whatever it is that they need to provide to show that the amount is supported. So by saying properly executed application or appropriate backup, that's not really specific enough. It doesn't give a timeline of when do they need to submit this by the what of each month, things like that. That's what what one keeps in mind when creating these contract terms, because it all starts there. In order to be able to find risks associated with that, we need to know what it is we're measuring up against. What is the criteria? So we just put a group. If you can't see the presentation now, don't worry, it's in there. We just put a few groups of specifications from different contracts. For the purposes of this presentation, we're going to focus on number 2, the auto answer customer service calls within 7 seconds with a 99% annual compliance, with the representative on the line within 2 minutes with a 90% annual compliance. So that's specific. Those are certain criteria that the vendor must meet in order to get paid for those services. And as we go through the rest of the presentation, we're going to be filling in like what can go wrong with it and what monitoring activities we can do as well. So now we're going to get into my favorite part, identifying the risks, right? What can go wrong? So we have the contract, we understand the contract terms, and now what can go wrong with it, right? Now we're identifying risks. So typically this happens from 2 sides. There's the programmatic risk, like Stefan said, that the goal is not going to be accomplished, right? And then there's the fiscal risk that we're paying more money to the contractor and we didn't receive the goods and services that we requested, right? So there's a programmatic and a fiscal risk that we can be on the lookout for. And now we talk about my favorite subject, which is fraud. So let's talk about what is fraud. So there's 4 elements to fraud. You have to have a misstatement, right? Mistake versus fraud. What is the difference there? Well, the difference is, let's say I'm processing a voucher for $1,000 and I hit an extra 0. And now that voucher is for $10,000. So the difference within it being a mistake and a fraud is if I had knowledge of the falsehood, if there was intent there. So intent. If I accidentally hit a 0 and the voucher went for $10,000, that's different than if I had a conversation with the vendor and the vendor was like, hey, if you process this for 10, we'll split the difference of the 9,000 extra and I'll be pocketing 4,500, right? So that's the intent. Then there has to be reliance by the victim. In this case, the state is relying on us to do our jobs appropriately. The taxpayers are relying on us to make sure we're doing it right so that money doesn't go out the door that's not supposed to. and there has to be some sort of damage, in which this case, it's a fiscal damage. There's money that's going out the door. So here's the actual definition from the Institute of Internal Auditors, from the Certified Public Accountants, the Certified Fraud Examiners. So fraud is any intentional act or omission. So there's the intent, there's the misstatement, the act or omission, designed to deceive others, resulting in the victim, again, the victim, there has to be a victim, suffering a loss and or the perpetrator achieving a gain. And that is the damage. Occupational fraud, it just means you're using your occupation to commit the fraud, pretty much. So we're going to go over a few statistics on how much is lost to show you the impact of this. 5% of annual revenues altogether were lost due to fraud. There's a median loss of about 125,000, and this is based on the 2020 report to the nations on occupational fraud. This is a report that the certified fraud examiners provide every 2 years. They study all these fraud cases. For this round, there were about 1,500 or so fraud cases that they reviewed, and they compiled all this data from there. And every 2 years it comes out. So on 2022, we can be on the lookout for that. Anytime between March and like July, they usually get published. So the median loss is 125,000. That being said, that's average. There's 178,000 lost to small businesses. Now keep in mind, small businesses are up and coming. They're not that big. So 178,000 is a lot of money to lose to fraud. Not-for-profits aren't supposed to have profits, right? Or very little in order to qualify to be not-for-profits. And they're losing 75,000 a year or per fraud case. And then the government's losing about 100,000 in revenues to fraud. So that's taxpayer money that's supposed to be going to back to the citizens, to the state, to ensure that we can accomplish our mission. And about almost a quarter of those losses were at least $1 million each. For those of you that can't see the presentation, this may look overwhelming to you, but bear with me. Just look at the bar graph, the blue only. So this is pretty much saying that for those fraud instances that we were just talking about, like the 1,500 or so, those that were identified within the first 6 months, there was about a median loss of $50,000. As you can see, it kind of goes upward. And for those frauds that were over 5 years, those were like about $740,000 was the median loss for those, which makes sense. If a fraud continues for years and years and years, well, that amount keeps adding up. So that's what the blue means. The red line, the line graph on here, that is more on the percentage of cases that last that long. So about a third of them get identified within the first 6 months. And then as you can see, it gets harder and harder to keep committing fraud and keep hiding it and getting away with it. And that's kind of why there's a downward trend for the percentage of cases that last as long. So it's kind of like an inverse reaction to both. Fraud is typically committed in 3 different categories. There's corruption, asset misappropriation, financial statement fraud. The most common, think about it, is asset misappropriation. So that means like stealing, taking assets or taking money, right? Cash, billing, tampering, things like that. The least common, if you think about it, it makes sense that it would be financial statement fraud, because how many people can actually go in and tweak numbers on the financial statement? And usually financial statement fraud is more on like overstating your assets and your revenue, saying you're getting more money or have more money than you do, and understating those liabilities, the things you owe. So that's pretty much how financial statement fraud typically occurs. And you get your most bang for your money for financial statement fraud, and there are lower amounts for fraud for asset misappropriation. And if you think of it, it makes sense as well, because you can take assets, you can take cash and things on the financial statement. Numbers is just tweaking numbers, and you can affect so much more. So the amount, it can be a lot bigger. And corruption's kind of in the middle for both of those. This is just so you kind of get an idea of what types of corruption frauds there are, like the different classes within corruption. And it's talking about like bid rigging, kickbacks, purchasing schemes. And look at asset misappropriation. There's like any and every which way you can steal money or assets. Cash has its own huge sections on the left-hand side, and then inventory and other assets are on the right. But there's an immense amount of ways you can commit asset misappropriation. We're not going to really go into financial statement fraud. That's why we talked about it a little bit ago. So where does it happen? It's 60% of the frauds happen in 5 sections. There's operations, accounting, executive upper management, sales, and customer service. So if you take a look at it, where is it that it's really happening? It's happening where you can affect money, where you can affect, well, for a financial statement would be executive upper management, but for the rest is where you can accept, have hands on the money or checks or assets and things like that. That's where the actual fraud happens. Okay, so why does it happen? As you can see, and even if you go back to 2016, 2014 is when I started looking at the reports of the nations, but lack of internal controls is always up there. And if you look at kind of the other ones, it's overriding those existing controls or lack of management review, poor tone at the top. It's all due to internal controls. So 30% of it is because of the lack of internal controls. And then you think back to where is the money lost? Let's say the small businesses. Well, it's hard to have internal controls in small businesses at times because you don't have a lot of maybe people within the organization, or you don't have the knowledge or expertise of a long withstanding management of a business, right? And it might be hard to segregate duties and put some of these internal controls in place if you don't have the manpower to do so or the know-how of how to do so. So I don't know how many of you have heard of the fraud triangle or the fraud diamond, but we're going to go briefly over it. Before I do, I want to talk about something that is very near and dear to my heart. I love cake. And so we're going to use an analogy and talk about cake during this part of the presentation because I love cake. And my favorite cake is red velvet with cream cheese topping, cream cheese frosting. Think about a cake that you like, the best cake ever, just sitting there waiting for you, right? If you don't like cake, you can think about pie. If you don't like pie, think about somebody you love that loves cake or pie, and think about them and how happy it would make them, okay? Before we go into this part of the presentation. So now you have a visual. Keep that there. We're going to talk more about that cake in a minute. So Mr. Donald Cressy said, in order for fraud to take place, we need to have 3 things. We need to have the motive that you want or need something. You need to have the opportunity to be able to commit the fraud. And you need to be able to rationalize to yourself that you should commit this fraud. So that was back in like 1970. He started talking about this idea, this concept in like the 1950s. But in 1970s when it got solidified and went through all its changes, and that was like the final triangle, the fraud triangle. In 2004, Mr. Wolf said, yes, I agree, you need those 3 things. However, there's one more thing, that even if you have these 3 things, fraud may still not occur. The last thing you need is the capability to do so. So let's talk about the motive. So think about, remember that cake? So think about that cake sitting in your pantry, your kitchen at work, wherever it is that you guys have your lunches or can sit down to eat. Think about the most perfect cake, your most favorite type of cake just sitting there. So you might tell yourself like, I want some cake, right? There's the motive. It's there. It's my favorite. I want it. Or you might even convince yourself that I need that cake, right? So how does that translate over to like payments, right? Money. So high debt, significant financial losses, excessive alcohol, drugs or gambling, extramarital affairs. Those are things that require money. And the list goes on and on. You can require money. You can have relatives that are sick, or you might be have health issues yourself and you need money to pay for these things. So that's the money aspect of it, the motivation, right? Like, I need this. And then there could be another aspect of it is the motive about perceived organizational inequities or job frustration. And you're like, you know what? I'm going to take some cake just because I don't want them to have it. So that could be your motive, right? So it can be you really want it or need it, or you can just, your motive is to take it just in spite, right? A resentment. Then we're talking about opportunity. So you're motivated, you want it. Now, can you actually do it? So let's say you want my cake, but you can't get into my building to take it. So the opportunity is not there for you, right? And don't take my cake. But so let's say you have access to your building. You know where the cake is, you see it there. Now, how can you get it? Are there people around? Can you find a way to make it so that there are no people around so that you can take it? So how does that translate over? Knowing familiarity with operations, knowing how to get in your building, ability to override controls. Well, how can I clear everybody out, right? Or maybe I know that every week, everybody on the floor goes to a meeting. That's my perfect time to go use a bathroom break, right? And take some of that cake. No periodic rotation of key employees. If you're the only one that goes into the pantry and nobody else goes in there, then it's a lot easier for you to take in. No uniform personnel policies. There's lack of internal controls. There's no cameras, right? Management does not prosecute or punish fraud perpetrators. So if my lunch is being stolen out of the refrigerator every other day and management does nothing about it, well, then there's even more opportunity. I can take it. Even if I get caught, nothing's going to happen, right? The opportunity's there. Now we're talking about rationalization. So now this is where you got to tell yourself, like, well, I worked out this morning, so I can have some cake, or I'll just work out twice as hard later this afternoon, right? You can say, you know what? I worked this job, so-and-so left, I got more stuff added to me, I'm doing the job of two, they didn't give me a raise or anything like that, so the least they can do is give me a slice of cake, right? So now that's your rationalization for getting this cake. How does that translate over on the payment side? They owe me. I'm overworked. I do the work of two people. They'll never miss it. It's a large cake. So if I take a slice, who cares? Like, they're not going to miss it, right? I'll borrow it. I'll pay it back. I'll just bring them a cake next week. I'll eat some today, bring some next week. I'll bake one. I'm really not hurting anybody. Again, it's large. Nobody's going to miss it. It's okay. Everyone's a little dishonest. Well, I just told you about them stealing my lunch. And everybody does it, so it's not that big of a deal. So here's where Mr. Wolf said, yes, absolutely. Motive, opportunity, rationalization. But some people still won't commit fraud. Why is that? And he said it's capability. So do any of you have friends where they just think about cheating or think about lying and they start breaking out in hives or start sweating, right? Have guilt trips? Like, so these people would probably have a harder time committing the fraud than others. Even if they did have the motive, even if they did have the opportunity, even if they could rationalize themselves that they should. So that's capability. So the first four, position, function, brains, confidence, ego, coercion skills, those are things like, okay, what if you're in a position to where not only do you know there are meetings, you can just schedule a meeting if you felt like it, and everybody has to go to it. Well, that puts you in a position to clear out that pantry or that kitchen area really quickly, right? The entire floor, if you felt like it, if you were in that position. The brains to do so. The confidence, ego, coercion skills. So convincing somebody to go somewhere so that you can take it. Then it's also the brains behind it. So let's say the cake's just sitting there, but there's not a single utensil anywhere in sight. Well, can I fold the paper plates that's there in half, use it to cut the cake? I'll use that same paper plate to then put it on another plate. I'll take it to back to my desk, eat it, and then discard it in the trash that nobody sees. Can you figure that out or not? You know? And then again, then we talked about the hives and things like that, the effective lying, the immunity to stress. If you are then able to walk back into the meeting like nothing happened, like you just went to the bathroom, or are you going to walk back into the meeting with everybody and be like, I hope nobody saw me. Do I have any crumbs on my face? And start breaking out in hives, and people are like, what's wrong with her? You know? So that's the capability aspect of it. So how does fraud happen? Motive, opportunity, rationalization, and it's torn depending on what books you read, whether or not they refer to the fraud triangle or the fraud diamond. But that can be your own opinion on which one you think is right. So now let's just talk about what it is we should be on the lookout for, like when we're looking for fraud or being on the lookout for fraud. Think about what you think the age is for those individuals committing fraud. If we were live in a classroom, like we'd be spitting out answers, but I know because of the situation we're in, we can't. So just think about it. If you see the most common, the typical. So when we go through this, we're going to talk about the typical and the worst. So the typical fraudster is between the ages of 31 and 50. So that's where it happens the most. And then the worst fraudster are those that are like 56 and older. If you take this presentation way back, like 4 or 5 years ago, we used to have everybody stand up in the room and people start sitting down as they didn't meet the criteria. So at this point, everybody that was 55 and under would sit down. So if you want to stand, go ahead and feel free to do so. If you're under 55, you can go ahead and sit back down. Education. So what do you think the education level is for the typical and worst fraudster? University degree is the most typical, about 50% of the cases. So bachelor's, master's. Then postgraduate degree, like those PhDs and all those technical ones, then become the worst, 200,000. So if you're over 55 and you have a postgraduate degree, you should be standing. Criminal history. This one takes a lot of people by surprise, but 89% of the people were never charged or convicted. Now, keep in mind that this fraud study was across all the nations, across public and private and government sectors. So a lot of times when you're in the public sector or private, sorry, what happens is that if somebody commits fraud, especially at the higher level we're talking about, those with postgraduate, been in the organization a long time, when they commit fraud, if that goes public, that company now has that tarnished reputation. It might influence the investors not to invest, and it may cause them to lose stocks, bonds, all that stuff. So what they do instead is like, go ahead and put your that you're resigning, and we're going to sign a non-disclosure agreement. You can't say ever that this happened, and we won't say that this happened. So now this individual gets to then go to somewhere else to work. When they call for a background check, we can't say anything. He can't say anything. So they just can move on to somewhere else and commit fraud again if that's what they do. So a lot of times they have never been charged or convicted. That doesn't mean it was their first time committing fraud. And now let's talk about occupation. So where is in the organization do you think that these individuals lie? As you can see, the employee manager, think back to how fraud's committed. That's the assets, asset misappropriation, right? At the employee manager level, they're more likely to be able to get that. But as we saw, that was low amounts of money. Where you can actually make a lot of more bang for your buck, I guess, for fraud is at the owner executive level, which can, what the existing controls are. You can override those controls and you get more loss for each fraud event. So those are all those CFO and COO and all of those things. Tenure. So again, kind of all these circle back around. If you look at it, anywhere from 1 to 5 years where you get an understanding of, oh, this is what's going on here, and I can take inventory, I can take this cash, I can do this. But you got a little bit of understanding of the controls or lack of controls and start doing that kind of fraudulent activity, and then you get more loss after you've been there for like 6 years plus. That's when the worst fraudsters occur. Now let's talk about gender. So this one's debatable. This one, if you see, men are just the worst. I mean, you do most of it and you make the most loss, right? You do the most damage. But keep in mind, again, this is across all nations, right? So around the world, on those fraudulent cases, that is the percentage. If you look at something like Southern Asia, look at the difference there. There's 96% males commit the fraud, 7% females. Now, let's look at the US. That's a lot closer, right? It's 59-41. And a lot of this has to do with, the glass ceiling, where typically in the past, most of those COOs, CFOs, all of those owner executive levels were typically held by men. So it's not that men are the worst. It's just that we haven't had the chance to catch up yet. Okay? So don't feel bad, guys. We just haven't been there. And to be honest, every time I open this report every 2 years, that is like the first thing I jump to, just to see, like, are we there yet or not? To see. And I promise there's like 5 more slides or so, and we're going to take a break. Okay? So just bear with us. And with this, I pass this on to Stefan.
Thanks, Jen. So I just want you guys to just think for a second. In what percentage of profiles the perpetrator did not leave at one single fraudulent act, but committed like repeated acts of fraud? So we have some choices on the slides. There's 12%, 93%, 77%. Just want you guys to think at what percentage do they did not leave it at one single act. Jen, you can go ahead and delete some choices. Thank you. And now the choices are down to 24%, 52%, 77%, and 93%. So what do you guys think now? What do you guys think is the percentage? We could go ahead and present the answer, Jen. So in 93% of profile, the perpetrator did not leave it as a single fraudulent act, but continued to commit repeated acts of fraud. But why is that? Why 93%? Why is that so high? Well, it's the I can attitude, right? So as Jen described with the cake, right? It's too easy. You can easily go and get it. It's the personal gain. They have something out of it that they could get. So a 1-year study conducted by the ACFE, consisting of approximately 2,500 cases worldwide of occupational fraud, found the typical fraud continued for blank before being detected. So how long do you guys think fraud continues until it's detected? So we have some options up here. We have 6 months, 18 months, 24 months. I just want you guys to think for a few. How long do you guys think it is? Jen, we could go ahead and share some of the answers. So we're down to 3 choices. It's 10 months, 14 months, and 22 months. Now, what do you guys think it is now? And we could go ahead with the answer, Jen. So it takes about 14 months. Typically, it takes about 14 months before fraud is detected. And how long does fraud typically go undetected for? So for employees, it's about 12 months. So even at the lowest level of an organization, it takes about 12 months to detect fraud versus like managers and owners, it takes 18 to 24 months. And how are fraud detected? So we have several choices on the graph. So there's like tips, internal audit. So as we can see, tips is at the top. And most fraud are discovered by tips. So it's important for agencies to have available resources to give people the opportunity to report like instances of fraud. Some, for example, I've seen like news articles that have like hotlines. These are some of the ways. And sources of tips, it's by employees. They have different choices, but at the top it's employees, then customer, vendor. So at a bare minimum, agencies should have resources for employees to report fraud. And as I stated in previous slide, examples within news articles and other things like hotlines.
All right. So now let's talk about red flags. So now we know what fraud is. Now, how do we identify some of these red flags? Keep in mind that if you're looking at things, documentation, things like that, and red flags are identified, that does not mean like stop the horses, let's call investigations, let's call the AG's office. We have fraud here. Red flags is just something that makes you take a second look at something. Something seems off. It could be an indicator of fraud. It could be an indicator if there's an error. It could just be something that lets you hone in on it. It's the accumulation of red flags that then starts to build a case for there actually being a fraud or trying to figure out what is actually the issue. So think about, we already talked about a friend that can't lie or they break out in hives. So have you ever met somebody and you shake their hand and afterwards you're like looking to see if your ring's still there, your watch is still there, or maybe you just got like a bad feeling in your stomach that something's just not right about them, right? So that's kind of what a red flag is. It's just a warning, something that you feel or see that makes you stop. So in order to have these red flags pop up a little bit more often, what helps is to have experience to know what normal looks like, so that when something abnormal comes across, it's easier to identify. Additionally, other things that help is by training, by receiving training, by seeing what things are considered red flags, that then after you have knowledge of that, even though if you've never seen that before, it'll be like, oh, wait, I remember there could be something wrong here, and it makes you stop. So that's what red flags are. So let's talk about document red flags. So if you're looking at supporting documentation and it comes through really fast or something and you're passing through, there's things that you might not pick up on. And it helps that some of these things you find after the fact, like after you identify one red flag, it stopped you to be like, huh, and then you find another red flag. So something that can stop you is if you notice that the signature looks like it was copied over to where the line underneath is not like straight, right? Or sometimes we've had instances where a documentation, the bottom part of the invoice looks straight, but the top part is just a slight bit crooked. So where it's not evened out, right? So that could be something that catches your eye and then it makes you look a little deeper to see what is going on here. With invoice figures don't add up. That can be an indicator of fraud. That could be that somebody crossed some or whited something out or copied over an amount or something like that. And they forgot to copy over, just because they copied over the total amount, they didn't copy over, let's say, and they copied over like the total amounts, maybe in the description, they didn't erase something and that didn't add up to the total amount for that invoice figure and then totaled at the bottom. So finding little discrepancies like that might lead you to then look a little further. Or it could be that whoever you're doing business with has a manual system where they type in amounts and they put something in incorrectly. Either way, it's a red flag. It could be an indicator to be like, well, now that I know that this is like a manual process or that the invoices are not going to come over accurately every time, I should maybe take a look at these a little more frequently to ensure that we are paying the right amount to this vendor. If there's no letterhead. So this is something where businesses, one of the easiest ways they can do marketing and to have their phone number information out there so that people continue to do business with them is to have their information on the top of an invoice. So if that's missing, it just leads to question as to why that would be. That could be something that they do, but it's just, again, it's just something that catches your eye. And then if you see that and the figures don't add up and something looks copied or altered, then it's like, okay, what's really going on? If there's any misspellings on a document, if a business sending out documents, you would assume that somebody has reviewed it, especially if it's like a contract or things like that. They have reviewed it and they ensure that there's no misspellings before it goes out the door. Or if there's vague information, this could be something that they're trying to get extra money that they don't deserve, or it could be that they didn't feel like writing everything out. For instance, if they have an invoice and it says 5 man hours, what does that mean? 5 man hours doing what? Where are they doing? What are they doing? What are we paying for? Handwritten endorsements. So this used to be a higher red flag than it is now, I would say, because so many more people have access to just go and print out something or type up something. But for the handwritten endorsements, there's easier to transpose something or write something in or create something than it was. It was easier back in the past than it is now because we have the capability of the computers. No phone numbers or fake phone numbers. Again, we talked about that's their main source of advertising, of having their information out there if you want to continue to do the business. So why wouldn't they have a phone number on there? Or if you see a phone number and then you match it up with their website or previous contacts with that vendor in the past and the phone number is not the same, is there something there, right? Is this invoice legit? Is this payment going to go to the right people? What's going on? Altered payee name. Again, these are things that you might see on supporting documentation where you could see that it looks like it's been altered. For the last two, they're more indicators of something like of shell companies. So PO box, suite number, mail drop addresses. If you look up a business in Google search, Google Maps, you can pull up that building and see if that is that business or not. It's harder to verify if it's a PO box because you're going to get a post office. You're going to see a post office when you search it. Mail drop address or suite number, you're going to be able to see a building. And at that point, yeah, you can do things like try to zoom in to see if there's any sort of signs or anything for that business to see if they're actually located there. For the company name, it's just people tend to use things like acronyms or not acronyms, excuse me, initials when they're creating shell companies because they're harder to verify. If you Google ABC construction company, how many of those are there, right? Or XYZ, whatever company. It's just easier to hide masks to make it seem like they're legitimate because it could be any of these businesses. And there's no tie specifically back to you. Route amounts or amounts under approval level. So let's talk about if you go to the store, how many times have you ever, if you've ever gone to the store and gotten to the checkout, you go to pay and they're like, it's $100 even. That's like, I should go play the lottery, right? That's never happened to me anyway. So, but again, these are just red flags. There could be a perfectly reasonable explanation. It could be that the contract pays $25 an hour for the service, and they worked 4 hours, so we wouldn't pay, taxes on it. So it could be perfectly reasonable. Why? Again, it's just to stop on your track. Does this make sense or not? If there's large dollar payments made with cash, if you get something from the vendor saying that they need to be reimbursed for these $10,000 and they send you an invoice and it's $10,000 to look like they paid cash. Well, who the heck carries around $10,000 cash to go pay, right? It's just a red flag. Could they have? Maybe. It's just a red flag. Vendor addresses, if they're not local, but the check is being cashed locally or vice versa. It's just an indicator of like, why doesn't this match? It could be a perfectly good explanation. They could have checks sent directly to a box that goes directly to the bank. So there are perfectly good explanations. That's just what I'm trying to hone in. These are just flags. When they build on each other, it's just an indicator to stop and then see if there's anything else going on. Bid rigging flags. So bid rigging can be done in a couple of ways. You can use fake vendors. We're talking about like shell companies, right? Where employees create bids on behalf of companies that don't really exist. Then you can have real vendors, and this could be one of two ways. It could be that it is a real vendor and they have no clue that you're submitting this bid on their behalf, but you're submitting it with a higher amount in hopes that you do get the awarded the lower amount so that there is some competition there and you get selected. And so it doesn't go out for rebid or things like that. And then there could be the shared owner with favorable vendors. So it could be that I own these two companies and I'm kind of going back and forth between my companies bidding against each other. So I know that I'm getting an award and there's no real competition because it's just myself. On another note, we've also seen instances where there's collusion, where let's say there's in this one part of the state, there's only 3 companies that can provide paving services on the streets there. So something they might do is they do like a round robin where it's like, hey, while it really, if they were actually competing for a bid, they might bid like $100,000 or roundabout, each of them individually. They know that they're the only 3. They get together and they're like, hey, I'll take this one, and then you can take the next one, and then you can take the next one. And then everybody bids like, I'll bid 200,000, you bid 210, you bid 225. And on the next one, I'll make sure that I bid higher than you. So while they're playing round robin, yes, the lowest bidder is getting the contract, but we are also now as a state paying double for what we would pay if they were actually having a competitive bid. So that's another form of bid rigging, if that makes sense. And you might find instances where somebody that's going to get the bid rescinds a bid, and those are little indicators of like, why did this person rescind the bid? Because it might be a parent or a shared owner situation, or like that, like I rescind my bid so that that person can get it, type of thing. Contracting flags. So similar, some of these things look kind of similar to some of the documentation flags, but like restrictive or vague specifications. So let's talk about like the paving again, out somewhere. And there's only 3 companies that can provide those services there. Well, if 2 of them have like 13 years experience or 10 years experience doing this, but you want your friend to get that contract and they have 15 years experience, by restrictive specifications, it could be that you require 15 years experience doing this type of work as one of your specifications to ensure that your buddy gets the contract and nobody else can bid for it. So then that's restrictive specifications. Or vague specifications on the other side, if it's something that requires experience, but you know a friend of yours that you want them to get this and they really don't have no experience, but you want to help them out in one way or another, you can just remove the experience qualification altogether just so that they can put in for this bid and be competitive within that. Then bids, quotes received from the same facts. This is kind of like a red flag for those where it's like one company submitting bids for others, either shell or a real company, where the other company has no word of it. So it's just odd that you would find 2 competitors using the same exact fax number to fax something in for an award. Along the same lines, let's say you find that red flag and then you're looking at both of their bids and they look exactly the same, like their letterheads are even similar. So then that's an additional red flag that you now added. And then so on top of that, then you see that one of them doesn't really have contact information on it. Well, why wouldn't they have contact information if you're trying to get an award and you want them to notify you of receiving the award? So those are just little red flags for that. And then one other red flag that's kind of unrelated to bid rigging is more if I am putting in for a contract for security guards. Well, there's a prevailing wage issue with security guards where for a licensed security guard, you have to pay them a minimum amount depending on the region, and it's published by Department of Labor. So if your contract requires for a certain amount of hours per week to be security at this location, and the bid comes in, but the bid's not for, there's no way that that bid satisfies the amount of hours you want worked paying the prevailing wage, well, that seems like they're trying to win the bid because nobody else is going to be lower than them if they're actually paying prevailing wage. So some of the things you might see coming your way if they do get the award is you're going to get a contract amendments going forward so for them to increase the amount of the award so that they can meet this requirement. Or you might find that you're not going to get all the hours that you wanted, Or you might find that you may be getting security guard services by unlicensed professionals, which then wouldn't get paid the prevailing wage. So those are all things to consider, to keep track of if you're looking at contracts coming your way as well. Or if you're reviewing contracts to try to find some to look for, to audit, to monitor. So we talked about not having contract information on there, contractor information, so that they can contact the vendor. So that would be one way that you're unable to confirm bids with losing vendors, or they don't answer. If the lowest bidder does not receive an award, there we're talking about like rescinding the bid or things like that. Or if the agency then puts a reason why they went with a separate vendor instead, there has to be documentation as to why, and it has to make sense. Lack of vendor contact information, we just talked about that. And signature on the bid is the same as the company name. So we see instances of that. It's just not common for somebody to go ahead and sign ABC Construction. You sign your name and your title, right? President, whatever, owner, purchasing, whatever it is that title is for the individual, and their own name, not necessarily signing the company name. That could be a way of trying to mask who it is that's submitting this bid, if it's like a shell company or something like that. Conflict of interest flag. So if you see these are flags more if you see that there's relationships between somebody like in your office and an awardee, where they're always going out to dinner, or maybe there's a familial relationship there, or maybe you notice that, hey, these payments are coming through, or these contracts coming through, and the address matches to Bob in purchasing, right? So that could be like a red flag. Unexplained or unusual favoritism to a particular vendor, like going out to eat, things like that. Or you notice that, hey, every time Bob awards a contract for this type of business, it's always to this company. And sometimes we just talked about the lowest bidder not receiving the award, and there's always a write-up as to why the lowest bidder didn't get it. So that can be an indicator of something might be going on there, where there's close socialization or acceptance of gifts from the awardee. Those kind of same red flags are those that you would see in the bribes or kickbacks. So unjustified favoritism. So it might not just be because we're buddies and that's why I'm doing it for you, but I might be receiving something in return. There's close socialization, again, with acceptance of gifts. And the big one, the big red flag, is unexplained increase in the wealth of an employee. So again, these are red flags. This does not mean that there couldn't be external circumstances as if somebody received money. There could be some instances of like trust funds or things like that. So it's not saying like, hey, this guy's coming in a new car. Let's call Department of Investigations. Let's call the AG's office. It's just a red flag. And then if you see that, and then there's unjustified favoritism, and then you see all these red flags adding up, then that could be a big indicator. And you always see, like, after the fact, when you watch like documentaries on fraud and things like that, and we were always wondering how he was able to afford a trip to overseas every 4 months, or he was always showing up here in 2-3, every 2 months with a brand new car, and he had a boat, and he had whatever the heck else, right? So those are just things to be on the lookout prior to instead of after the fact. And again, fraud can happen anywhere. It can be in the mailroom. It can be inventory in the warehouse. You can work at a small cubicle. You could be the COO, CFO, whatever of a company. You can work as a board member for an organization. You could be a politician. It doesn't matter. Fraud happens everywhere. The last slide for red flags, guys, or Stefan touched on this a little bit, billed for services. It's just harder to verify than that of goods or services. You can see if laptops are there, if they were delivered. To determine if training took place last month, you have to rely on supporting documentation, on sign-in sheets, on maybe calling the hotel that the training took place at to try to determine, was there a room booked for that time, or reaching out to maybe some of the attendees to see if they actually did present, or is there CPE documentation if CPEs were awarded. No supporting documentation submitted. Stefan's going to hone in on this, but this is the one thing, if you take out of this presentation, is Supporting the documentation, supporting documentation, supporting documentation. If at all else, have supporting documentation be something that is processed and sent in along with payment to your agency. And Stefan's going to get into the whys and everything like that, so I won't steal his thunder. For relationship between sponsoring legislators and executives, that we're talking about if there's a legislative member item. If you have a contract for legislative member items, to be able to see if there's any relationships there. And some of the things we use to check on those things are the financial statements, the 990s. Those are pretty much like tax documents for not-for-profits that they have to submit annually. And if you go to guystar.org, it's free. You just have to register and you can look up any not-for-profits 990s going back years, and you're able to see on the 990 in different sections, those on the board of directors, any officers, any compensated employees, the highest ones. You're able to see their names on there. Then you can also see independent contractors, who they've paid in the past, the highest paid that received more than $100,000. You can see that on there. You can mirror that or use that. You can use things like Google Maps to see who's related, white pages, see through New York to see if they seem to be getting all of the awards. Well, is there somebody in your agency that has, similar names, things like that? You can also see on See Through New York. And then there's LexisNexis Accurate. I'm not sure if every agency has the ability to do so. There might be just like one or two people, if so, that can run Accurate at your organization. There could be more, but that is something that also gives you a little bit more assurance. You can do get kind of like a more detailed background on businesses, on individuals, and you can also see like relationships between businesses and individuals as well through there. Then why don't people report their suspicions? If you do see something, why don't people not say it? Well, one of three things. They can have fear of repercussion. They're like, I know what happened to Joe the other day or last year. He got transferred right out of here because he's said something about Bob, and there were red flags about Bob, right? And if there's a Bob on here, I'm sorry. I'm not talking about you. This is an imaginary Bob. If you feel like nothing will be done, so why waste my time if nothing's going to get done anyway, right? And if it's an inconvenience, right? It's not my problem, so I'm not even going to get involved in that. That can be the mind frame of some individuals, and that's why they don't report their suspicions, which is why it's important to have the anonymous hotline so that it doesn't come back to the individual if need be. And we also, even if it's not anonymous, we have the whistleblower law that's supposed to protect you, that prohibits from disciplinary action taken against an employee that reveals information. So that's the whistleblower law. So now, remember we went back to this chart way back when we looked at understanding contract terms. So we went with number 2 about auto answering customer service calls. So what can go wrong? So something that can go wrong is that the calls are answered outside these time periods on average, some extending the 2% penalty variant in the contract. So we found a specification. We said what can go wrong with it. And then we're going to talk about a little bit later about what we can put in place to monitor these things. So now we understood the contract terms. Well, we got the contracts. We identified contracts we want to look at. We understood the contract terms. We identified risks within those contracts. Those are the step 3s. Step 4, prioritizing the risks. And don't worry, a lot of these last steps, like 3 of them, are like 2 slides long, okay? So prioritizing risks. So we use what's called a risk matrix. The risk matrix pretty much says the likelihood, what's the likelihood or impact that something can go wrong. So what's the likelihood of it, and what is the impact if it does go wrong? So let's think about a $50,000 contract and a $5 million contract, right? Just from a fiscal standpoint, the $5 million is going to be higher impact than the $50,000. So that's given. So that's where we're talking about impact. We're not talking about the likelihood yet. We're talking about the bottom, right? Where do we put these as far as risks? Then on the counterpart, let's talk about two $50,000 contracts. One's for landscaping services and one is for elevator maintenance. Although they're same as far as fiscal comes, as far as the same amount of money, if the grass doesn't get mowed as often or as it should, and if the elevator maintenance is not done as often as it should, there's a higher impact if the elevator is not maintenance, doesn't get as much maintenance as it should. So even though they're the same amount, the impact might be higher for that one. So there's a lot of things where we talked about the different risks. So that's what we're kind of talking about. What is the impact for all of these contracts? Then comes the likelihood. So the likelihood is like, how likely is it that something can go wrong with this contract if it's not monitored, right? So that's a start base. Then you look at what controls are in place, and that can fluctuate. That's what you at the agency can affect. You can affect the likelihood of something happening there depending on what controls are in place or what system controls, or learning some controls about the vendor's process as well, and knowing what controls are there. So let me show you kind of what it looks like if we were to plot some controls in there. That's what it would look like. You would see something in quadrant 1, 2, 3, and 4. So now that we prioritize risks, we put them on there and where we think the impact is and the likelihood of is based on the current controls, we would then need to determine what is our risk response. So these are there, and we're like, you know what? With our level of resources at our agency, we can only look at these risks. So what does that mean, right? Or, you know what? We can only look at these risks. So what can we do? The areas of most concern. So we can then determine our response, whether we mitigate the risk or we accept the risk. So let's talk about mitigating it. That means revising some procedures, maybe improving control system, increasing auditing, right? So let's talk about these. Maybe all of those in quadrant number 2, we can bring down into quadrant number 1 by adding some extra procedures, actually adding some extra controls. So that then it's like, okay, I feel a little bit better about only having the resources to look at this area over here, right? Or accepting. So what does it mean to accept that we're not going to look at anything? That does not mean that I accept it, so that's the end of it. I never look at this contract again. That means for the time being, I accept it. I don't have the resources to look at it, but you can reassess your risks again later on and determine if this one has gone up, if it has gone down. If this one's gone down, maybe I can now look at this one. So accepting it just means for the time being. Additionally, accepting means sharing that with your upper management, pushing it up and saying, look, this is the impact if we don't have the resources to look at these things. I just want to make sure you're on board because we can only have the resources to look at this. And they can say like, okay, I understand. And you know what, that's the right approach. Or they can say, no, we need to look at that. And that's your way of fighting for additional resources to be able to look at those things and prioritizing those. So accepting does not just mean like, I plotted it, I can't get it to it. That's the end of it. And now we're going to talk about designing and executing monitoring activities. And I'm going to hand that off to Stefan.
That's perfect. Thank you so much, Jen. So as Jen stated, the next step we're going to talk about is design and execute monitoring activities. So for design and implementing monitoring activities, so these are just some of the steps to mitigate risk. So some of the things are like, some of the questions are, who's going to do it? How are they going to document it? And who are they going to get the documentation to? So we just have a quick story. So we were reviewing a voucher and we received documentation from the agency. And on the documentation, it had okay with a circle around it. Well, we reached out and we asked finance department, well, what does that mean? They said that the goods were received and it's ready to process. Well, we asked the program aides what the okay with the circle means, what that meant. And they stated that the goods were received and finance department just reviews the rest. Well, in this situation, no one was checking to see if the rates are in accordance to the contract or ensuring that the contract amount was not exceeded. So as we stated within the slides, it's who's going to do it, how are they going to document it, and who are they going to give the documentation to. And the next side, monitoring, the same thing, just ensuring that things are operating as intended. And evidence. So is it enough information? Is it sufficient? Is it the right information? Is it appropriate? So just as an example, I just want you guys to think about this. So for like a box of pen, maybe receiver report might be sufficient with 200, and compared to like laptops, let's use laptops as an example. Well, maybe actual observations to ensure that the laptops were received, that might be sufficient. And with the right information is inappropriate. So would timesheets be of individuals who received the laptops? Is that relevant and appropriate in this situation? Maybe, maybe not. So, and the type of evidence. So we have an acronym for this. It's Thomas P. DiNapoli. So T for testimonial, D for documentary, and P for physical. So we're going to use the box of pens as an example, right? Maybe an email stating that it was received. That's testimonial. Versus with documents, maybe like a receiver report stating that those pens were received. And with laptops, now with the example, maybe there's like tracking number, that's stronger evidence. If we do like a visual observation, that's more reliable and like stronger evidence. So those are just some quick examples of that, of what's most reliable and what's least reliable.
Can I just touch on something real quick on that? So on that, absolutely, on what is more reliable, and also take into account that the same type of information can be more reliable depending on the source. So if the person trying to receive payment gives you documentation, that might be less reliable than somebody that has no part into it. So to Stefan's point, if the vendor says, yeah, I shipped the laptops, here's the document saying that it left my warehouse. Okay. All right. Good for you, you know? But if you can then get a tracking number or something that you can track through like UPS or another website, and it's for the same amount of the same amount of weight, and from that location to that location, that might give you a little bit more reassurance. Same as a testimonial. A testimonial with somebody in the room that has their supervisor there or a manager might be not as free-flowing or not as reliable as somebody that can give you a testimonial obtained independently.
And perfect. So as Jen mentioned in the past few slides, we're going to focus on the second part of this chart. So Jen discussed a specification. She discussed what can go wrong. And in this example, we're just going to discuss how can agency monitor that situation with the customer service calls within 7 seconds. And just the example we have in here and how to monitor is in this example, they can like review monthly and annual reports of system performance to identify any like discrepancies or anything. And then based on those variants, well, then we can determine the need to assess penalties. So that's just a quick example of how agencies can monitor that.
All right. So contractor concerns. So we talked about concerns that you have at the agency in monitoring these contracts. So in the same token, there are some concerns that the contractor may have as well. So we're like, well, I don't get paid on time, or now they're asking for more documentation and I've never had to supply that in the last 3 years of the contract. Now all of a sudden they want, extra information on invoices and things like that. So some of those concerns can be mitigated by those specific SMART contract terms, by telling them exactly from the start point, this is exactly what's expected of you that needs to be provided, by enforcing that, by telling them that you need to provide these things in order to receive payment. Additionally, by having timelines in there, like, well, by the 5th, you need to provide this documentation if you want to get paid timely. So by having those SMART contract terms, it'll help the contractor's expectation as well as your expectation, and it will decrease kind of like the back and forth on now you want this, now you want that. That was upfront, and you knew about this from the get-go, and it gives you a leg to stand on. We had a call come into our agency discussing that an agency will not pay us. Like, I sent them everything they needed, they won't pay us, and so they owe us like $100,000. So then we reached out to the agency and we're like, hey, what's going on with this contract? The vendor says this, and the agency said, here's our contract. We said that they need to provide this report to us, and they're not sending it to us. So until we receive the report as indicated, and here's the email back and forth telling them that they need to provide this report, and they still haven't, so they're not receiving payment. So we were able to go back to the vendor and be like, you need to provide the report. It's in your contract. So it was clearly outlined. It was a specification that can be enforced, and the vendor ended up providing what was required per the contract and then getting paid. So who should monitor? So it's a team effort, guys. At the program staff, we talked about the program staff, the finance staff. If you have any consultants that may play into factor into this, agency auditors, and then us OSC auditors. Now, before you roll your eyes, and in person, I get pity looks after I pop this up because I am a Miami Dolphins fan, and we're in football season, and we don't do so good. So I usually get pity looks, so I'm glad that I'm being spared that at the moment. You can keep your thoughts to yourself about the Miami Dolphins. Just kidding. So let's talk about a payment. So a voucher is created. That's the football, right? So what's our first line of defense? Program staff. They know what should be getting delivered of goods or services if it actually happened, right? The program staff has the know-how of what should be coming in and how and if it did. Then comes the finance staff. And again, talking about Stefan's situation, as long as there's communication there, like, hey, we're doing this part, you're doing that part, and all the blocks are checked, then that's good communication, and you can cover that voucher. And it's like, okay, it can go through or it can't. There may be things that maybe the program and the finance staff don't have the ability to know if we actually got all the specs. Like, let's say there's a construction or something that they need an external consultant to know that they are getting the goods and services that were being provided. So that's like an outlier. So he's out there also trying to stop whatever comes that way. And then you might have the agency auditor free flowing back there, like kind of like a linebacker, if you know football. If not, they're just somebody back there also to try to catch things, right? To try to catch things going your way. And then there's us. We're kind of like the safety standing in the background, waiting for anything to come through, any Hail Marys, things like that. So this is just one voucher for one payment for one business unit. Now imagine all the payments for one business unit, how many footballs there are there. We approve and audit. We approve about 20,000 vouchers a day. This could be from on the regular voucher side. This could be from travel and expense as well, expense vouchers, but about 20,000 daily. And our bureau consists of 80 people. So any given day, we can have, if this puts it into perspective, these are just 8 different BUs, let's say, with just one payment coming through each line. We can have a payment for nursing. We can have a payment for bridge construction. We can have a payment for landscaping. We can have a payment for computers. We can have a payment for some IT stuff. So by no means do I consider myself an expert in any of those fields, but we have an understanding of what the payment should look like, what supporting documentation should be provided for some of those things, and we try to catch all of those. So OSC, we're like the last resort, right? So we really heavily depend on the expertise at the program side, on the finance staff at your agency that deal more in depth with those kind of contracts. Those programs know those contracts more in and out than we would ever know, because we are monitoring right now. There's about 80 business units in SFS. And again, about $20,000, 20,000 payments coming through daily. So there's no way we can just be subject matters at everything. And we rely on the team, all of us together, to ensure that the vouchers that are coming through are appropriate, are just due and owing before they go out the door. So how much should you monitor? Again, the time and the extent varies on the impact, the likelihood that something could go wrong. What was your, we're going to talk about number 7 on following up and knowing what their process was in the past. How reliable vendors are they in the past? When should you reassess and things like that? So the time and extent really does depend on the contract, on what is coming, the impact and the effect it will have. So let's talk about human communication before we start talking about site visits. What percentage of communication do you think comes through on just words? So we're talking about email here, right? What's typed in words? What percentage of communication do you think that is? Think about it. And then you can even add on messages. So that's like what's hidden messages. So let's say you say, did we receive all the laptops on this invoice? And the response is, we received laptops. Okay, so the words are saying you received laptops. Is there something hidden? Like were they just writing shorthand? Or were all the laptops received or just some? Is there any hidden messages there, right? This is just from reading an email. So just to let you know, it's 3.5% of communication is through words, 3.5% through messages. So if you get an email, you're getting 7% of the communication sent your way. 93% of it is nonverbal behavior, whether it's body language or tone of voice inflection. But as you can see, even tone of voice, 38%. You add the 38 plus the 7, the actual words coming out of somebody's mouth, and you're about 45%, so almost halfway there. So even if you're verifying things and looking at documentation or something like that, picking up the phone, calling the vendor, getting more of an insight of what's going on, what was processed, what their process is like, you get almost half of the communication as opposed to only 7%. So if there's one thing you can do, pick up the phone. If you can't do site visits, obviously through site visits, field visits, you're able to get the full picture, the full 100%. But even at a minimum, just picking up the phone dramatically increases how much communication you're actually receiving. You can hear the pauses. So in those words, in the same language, we were talking about the computers. If you're talking to somebody, you're like, hey, did you receive all of the laptops on invoice, blah, blah, blah. And then they're like, we received? Yeah, we received laptops. How much more are you getting? And even now, with even having the capability of webcams and things like that, you might be able to then even see facial expressions, which can then add up the other amount as well. So not necessarily site visits, but you can also actually visually see the individuals as well and their responses and kind of like their tics and things. So these would be all of the things you're missing along with the tone by just communicating through just email. And with that, I'm going to pass it over to Stefan.
It's perfect. So as Jen mentioned in the past few slides, the next step next process we're gonna talk about is site visits. And in this example, we're gonna use laptops. So for the laptops, before you go, what do you already know? So you know that the laptops were ordered and received. What do you still need to know? Verify that the laptops were received. What do you need to see? The laptops, maybe there's like, usually there's serial numbers on the laptops. Who can tell you? Agency personnel. And who can show you, maybe if the laptops are in a closet, who has access and who can provide you with that. And at usually on a site visit, make sure you ask all and any questions and even follow-up questions. It's the how, why, when, what, where, who. Just ask as much questions you're there. Take advantage of it. So professional skepticism, it's an attitude that includes a question in mind and critical assessment of information. So just want to give you guys an example of this. So let's just say, for example, there's 2 kids in a household and they're running up and down the hallway and something breaks. Well, now you're trying to figure out who broke it. And you're sitting there, you're trying to figure out who broke it, what happened. And then you're asking each kid, like, the same exact questions. So you're trying to figure out the answers. You're trying to have a question in mind. You're trying to have a critical assessment of it as well. So, yeah. And so question in mind, why? Show me, does this make sense? And how can I verify that? And interview process. So what are some of the things as well that's part of the interview process? So for example, we have like outlines. Hey Jen, can you so for example, you could prepare. So for example, like Jen and I, or for example, like I would use like an outline whenever I go on site visits, just to make sure I have all the questions that I have and want to ask. You want to build a positive relationship as well. So like as Jen talked in past slides, so you build a relationship with them, you get to see what's the normal and abnormal behavior. You get to ease the tension. Like for example, are they sweating? Are they biting the nails whenever you ask certain questions? These are some of the things that are abnormal, or is that like normal behavior? So you get to see all of these things within it. Use an open-ended question. So like as Jen stated, like laptops, for example. So let's just say you ask close-ended question, did you receive the laptop? Say yes or no. Versus an open-ended question, you can say, please explain your receiving process for the laptop. So now they're going to explain the situation. So purchasing department, they order the laptop, then it's sent to a facility, then the receiving department, they check and make sure that everything was received, to have a report. So you get the entire process of how that works. And leave a business card. So in this situation, like hand it to everyone in the room so they can contact you, because people might be hesitant. Their managers might be around and they're hesitant to go up and take a card. And employees may contact you because like they're afraid to say something because their boss were in the room. So as we said in past slides, tips provided by employees are the best way to detect fraud. So desk audit. So phone calls versus documentation. And as Jen stated, so you pick up the phone, you call. That's an extra 30. You go from 7% over email to approximately 38%. So you get an extra 31%, and the level of communication increase. And with documentation, so if there's one thing to take away from this presentation, it's always requires supporting documentation for to be submitted with requests for payments. It's a huge deterrent for vendors to commit fraud. So let's just say, for example, if two agencies have a contract with a vendor and one required documentation and one doesn't require documentation, and you want to commit fraud, which one would you choose? So most likely you might commit fraud with the agency that doesn't require documentation. And it's important to request documentation as well. So because if you identify like issue with a payment, well, we can go back and check to see, is it a one-time thing or is it an ongoing thing? So, and the vendor, they don't know if you're reviewing these documentation or not. After the road trip or the site visit, so it's, what did you learn? Was everything okay? Were there any red flags? Who needs to know? So usually if I go on a site visit, I would just type up like a summary of the meeting, and usually I would try to do it like the day off so I don't forget. So let's just say, for example, on a Friday, you go away for the weekend, you come back on Monday. Well, you probably forgot everything that happened at the meeting. So it's just good to have like a little write-up of what happened. And qualities of an effective monitor. So just 4 things. It's strong attention to detail, critical thinking, strong communication skills, and professional skepticism. And I will pass this over to Jen, where she will wrap this presentation up.
Right. So we're a little bit ahead of schedule. Typically, this class takes anywhere from 2 to 2.5 hours. Last year, we were running kind of short. So we gave it a little bit extra buffer, but I will get you guys out of here definitely before lunchtime. So final step, right? So How many steps were there again, right? The first step, finding a contract, right? Identifying a contract, then understanding the contract terms within that contract. Then you identify risk within that contract. Then now that you have those risks, now you prioritize them, right? The risk matrix. After that, you then think about what your response is going to be to the risks. Then you're going to design monitoring activities for those risks. And then the final after that is following up. So let's see that you're reviewing a contract and you find that they have a high degree of compliance, right? Their vouchers seem to be good. They have the supporting documentation. Everything seems to be fine. So maybe that's something that, well, although it was risky, it seems like, look, they're doing what they're doing. It seems fine. Maybe we can just focus our resources on something else that might not be as have as high degree of compliance, and you can then just reevaluate at a later point and possibly reduce the monitoring frequency for that contract. Let's say you have a degree of compliance that's moderate. So there's a few things here and there where they're like not all the way good, right? So you can identify to the direct to the contractor, like, hey, we're finding these issues, what's going on, have them correct those deficiencies, do some sort of correction action plan if it's necessary. You can advise your accounts payable, like, hey, be on the lookout. We talked about maybe their invoicing is all manual and you found issues or indicators where that's not they're not correct all the time. So it could be something you can be like, hey, be on the lookout for these vouchers. The amounts don't total up all the time, right? Identify and recover any overpayments going back. Stefan said you'll have the documentation there you requested for previous to see if it's a one-time thing, if it's been an ongoing issue. Maybe they just migrated systems and right now it's not good, but in their old system, everything was fine. So to know where to target your resources to look at. So you can identify any more if it's in the past. If you haven't requested documentation, that doesn't preclude you from requesting documentation for the past. You can still ask for supporting documentation for previous payments if you didn't have them already. And you can recover any overpayments, increase scrutiny, maybe take a closer look at these payments for these contract, increase frequency to follow up on some of these monitoring activities to see if they are implementing some of those things, deficiencies or corrective action plans that we've put in place. Now let's talk about those vendors that possibly have low degree of compliance, right? So some of the same things, right? We'll come up with a corrective action plan where it's practical. You can definitely increase the frequency or following up on monitoring activities for those. Increase scrutiny. We'll come back to terminate contract. Advise accounts payable. Identify, recover overpayments. Consider referral for prosecution. That's in the instance, like, let's say there is fraudulent activity, then yes, to be, referring it to the proper authorities for prosecution for that. But let's go back to terminate a contract. So this is something that is not done lightly. This is something that you definitely need to consult with your legal before you do this type of take this avenue of approach, because there are times where there are some services that you can't just break right then and there, right? We're talking about things that can be health and safety, where you need to have another vendor ready to pick that up and move forward with it, like a light switch, like this one's off, this one's on type of thing. And you can't wait, like, I'm just going to terminate your contract, then go out and put for bid, then go out and try to get another contractor to, so that you might not have that flexibility to do that right then and there. To just terminate a contract just like that. There could be legal ramifications if so. So that's why always consult with legal if that's an avenue that you're looking to take. All right. Review. So again, we have the 7-step process. So we're identifying those contracts, guys. Again, what do you have available? You might have things that at your disposal at your agency that is more honed into your own contracts, have more details that can be better for you to use than like Open Book. We went over Open Book is open to everybody for all state agencies for you to be able to look at. But you may have your own records within your own systems. Understanding the contract terms, again, get in the deep. And just because some contract terms are not specific does not mean that, well, there's no way for me to figure out if that's right or wrong. No, you can then look at comparable contracts, see what common things are. We do that all the time. We had a contract where it said it was for recouping money, right? Like if somebody doesn't pay what they are owed and then they go and they try to recoup that money, right? So what happened was that they had like percentages for anything over like $2,500. They would use this rate. That would be like their incentive to recoup that money because they would get a portion of it. If it was under 2,500, it would be this rate. And there was a certain criteria where the rate said it could be anywhere from 15 or 5 to 20%. And we were like, well, what does that mean? What can they charge? And so we went to our contracts. We were like, is this common or something like that? No, that's not common. And we worked with the agency, expressed it to them, and they had additional guidelines to narrow down that percentages to ensure that the vendor was billing appropriately, and it would be something that we worked into a future amendment to ensure that that's included in the contract. So just because a contract is not specific enough or measurable enough does not mean you're just like, I can't do anything about it. There are things you can do, and you can ensure that there's effective change and make that happen. We talked about all of those other criteria when we went through it. Identify what can go wrong. Again, from the programmatic and the fiscal side, it's not just money going out the door. It's also the goals being accomplished, right? The outreach isn't being done for the example we gave. So that's an issue. It's not just the fiscal side. You found the risks. You prioritize them based on likelihood and impact. Again, what can the agency affect? Can they affect impact? No, the impact is what it is, right? But the likelihood, that's what you can affect by the controls you have in place, procedures, and things at your agency that you can mitigate those risks by making it get lower based on those controls you implement. Determining the risk response, again, and accepting, again, does not mean it's, oh, well, I'm never going to look at this again. No, you follow up, you look and see if you can reassess, if you can push for more additional resources to ensure that you're accepting those risks you can't look at, and it's not just stopped at your level, you push it on up. 6, so designing and implementing monitoring activities. So in the example, that's exactly right. That is exactly right. The finance department thought the programs department was checking off on making sure the budget and the rates were appropriate. Programs department thought finance was doing it. Nobody was doing it. So it's who's going to do what? Remember, the teamwork, the collaboration. How are you going to document it? If it's okay in a circle, but that means this, well, the other person knows what that means. The other department, I mean. And who are they going to give the documentation to? As long as everything's being taken care of, then that's what counts. And then finally, following up, not just leaving it as like, these words were good. Things can fluctuate, and different contracts can go from a high degree of compliance to a low degree, and they can fluctuate. So it's not just I assessed them all this one time and that's the end of it. It's following up after the fact and keeping the monitoring process going. As discussed very early in this presentation, this is the guide to financial operations. There's a link in there. It's section 11F. And this goes into every one of these steps, a little like summary of them. And the most important thing is there's an Excel in there that has kind of like a walkthrough of each type of contract that you can use at your agency. Come up with your own if you want to use the 7-step process. But it's a very interesting section of the GFO to read. With that, I'll leave you with a final thought from Ms. Margaret Mead. Never doubt that a small group of thoughtful, committed citizens can change the world. Indeed, it's the only thing that ever has. I didn't see many questions in there, but if you have any questions, specifically if they're for like specific to your agency, any contract specific, like very detailed, please feel free to email myself or Stefan. Our business cards are in the presentation. Those are our actual addresses. Those are our actual phone numbers. So feel free to reach out to us. If you have anything that's general, feel free to ask it. Otherwise, we very much thank you for your time.